Recording in progress.
Well, welcome to auditing, and what we're going to be doing today is going back into chapter 2, picking up where we left off and finishing up the chapter. We may get to the chapter 1 homework with whatever time is remaining at the end. Well, here in chapter 3, with audit reports, we know they're very, very important, heavily tested on the CPA exam, certainly. And there's quite a bit of information in them. Not difficult information, but just information that we have to go through together so that it will make sense. So we were just ready to start with scope limitations. And with scope limitations, I'll show you here just for a second where they are in the notes. They're right here with, let me get the Roman numeral 2C. So we're just right there. We'll talk about scope limitations. When it comes to scope limitations, we're going to have 3 possible levels of materiality, and we will in just a bit with departures from gap 2. So if we have a scope limitation that is very small, and granted most will be, well, for that very small scope limitation, nobody really cares. So if we have a purchase, it's very small, documentation's missing, let's say nobody saved the receipt, well, nobody really cares. It makes no difference. So with these levels of materiality here, just that camera there, with levels of materiality and the type of report that we're going to give. Well, with something which is immaterial, this small scope limitation, a little bit of documentation is missing, type of report that we can always give, since nobody really cares, is the standard unqualified audit report, the clean opinion. Sometimes we say unmodified audit report. Pardon me, that scene there in that class board trips up my writing. And there we go. Chart here. Just okay, good, that helps. All right, so standard unqualified audit report for an immaterial scope limitation. So now, if this little scope limitation here becomes bigger, well, now we're faced with something which is going to start ballooning up into the material phase. And we have 2, well, broad categories of materiality, shall we say. We have one that's material and one which is highly or pervasively material. So if I bump up a notch, I have one is simply material. Sometimes I say in between. Materiality. And then highly or pervasively material. Since I forgot to bring my step stool in. Use this chair. Okay. Ooh, excuse me. For our in-between level of materiality, we're going to have a modified or qualified audit opinion. And if we go all the way up here, we're going to have a disclaimer of opinion. It's really bad. Apologize for that marker. Kind of scarce around too. Next time I'm at the dollar store, maybe I should just break down and buy a pack of the generic brand markers. Or, well, I shouldn't say dollar store really anymore. I should say $1.25 store. All right. So again, this gets bigger. We're in the in-between materiality phase. It does not pervade the financial statements, doesn't soak all through. So we can get by with a modified or qualified audit report. And I will show that to you. But then if it gets bigger still, it's bad. The highly or pervasively material phase, all the way up at the top. That calls for the worst scenario type of audit report. Disclaimer of opinion, it says we cannot give one. So let's see that put to work. And if I come back here to my notes, chapter outline, you'll see what I need. So here in C, to reiterate some things and introduce a few new points. Well, scope limitation here in C may result either from conditions, such as when source documents have been destroyed in a fire. Well, the client couldn't help that. I might add, that's poor internal control. They didn't have things backed up as they should, but still, it's not intentional. It's not done to cover something up. But the other condition is, or rather the other situation is, it can be from the client, such as when management refuses to allow the auditor to examine some needed evidence. Now, if management refuses to allow you to examine some evidence you would like to see, what do you start suspecting right away? Something to hide. Yeah. It's rare. But we still need a tool to convince management not to do this. That's because the audit report would change. So, scope restricted by conditions. That is by far the more common type of scope limitation. Client couldn't help. Now, the scope limitations we know will cause the auditor to issue either a disclaimer of opinion if it's all the way up at the highly or pervasively material phase, or a qualified report. We could also say modified if it's somewhere in between in materiality. And it's often harder to decide upon materiality for scope limitations than for departures from GAAP, by the way. This because we don't necessarily know how many dollars are involved. Since we could not conduct all the audit procedures we felt we needed. Thus, we may play it safer and more quickly decide the situation is highly material with the scope limitation. You know, if in doubt in accounting as well as here in auditing, it's a subset of accounting. We always play things safer. We err toward the side of caution, toward the conservative side. So if we're in doubt as to whether a scope limitation is in the in-between materiality phase, or if it's all the way up to the highly or pervasively material phase, we'll go for the highly or pervasively material phase, playing it safe. Now, reading on. Thus, we may play it safer, more quickly decide that a situation is highly material with scope limitation. Also note that we're going to be especially quick to decide that a client imposed scope limitation is highly material. In fact, the auditor may instead withdraw at this point, especially if he or she appealed to higher levels of management and did not obtain a satisfactory resolution. So trust me, we'll go all the way to the audit committee. And if we still don't get a good resolution, that sounds like a really poor tone at the top there with this client. The audit committee didn't loosen up and give us the evidence. So yeah, that sounds like a client who is really earning that disclaimer of opinion. It truly is. Shame on them. Not the type of client we want. Definitely this disagreement is going to be noted in Form 10K and in the footnotes, the financial statements, and it's going to look bad. Clients don't want to get that far in. So we usually won't have this problem, but just in case, we know what we do. Now I'll show you some examples on page 64 in a second. We're going to note 3 things here. In both set reports, the section of the basis for the qualified or disclaimer of opinion precedes the opinion section. This way we'll tell the reader what is wrong in a paragraph we add, an explanatory paragraph, before the opinion paragraph. This way, the reader reads down through what's wrong in this so-called explanatory paragraph, and by the time they get down to the opinion, which is not clean, they know why it's not clean. So that placement, you'll find I tend to stress throughout the chapter because guess what? They do the same thing on the CPA exam. Now, second, in the qualified report for the in-between materiality phase, that is, the last paragraph of the auditor's responsibility section has changed just a bit to reference the qualified opinion. And the opinion is qualified with the phrase except, and I will show you. And the rest is the same as in the standard unqualified audit report. But then number 3, when we turn our attention to the disclaimer of opinion in a minute, we'll see that the section of the auditor's responsibility is changed in wording and shortened by omitting the last 2 paragraphs, as effective audit cannot be conducted. The introductory paragraph is modified to say we were engaged to audit instead of we audited. Do an effective audit, that's why. And the opinion section is actually a disclaimer of opinion saying that we cannot give one. So let me go to the book on page 64. I'll show you these things in action here. So here in figure 3.8, qualified report, qualified audit report due to scope restriction, scope limitation. Under AICPA standards, this is a privately held client. If this were a publicly traded one, we know it would say PCAOB standards. So this independent auditor's report, again, we're just concentrating on what's modifying because most is going to be the same as we've already seen in the standard unqualified audit report. So here in this report, we've got the same introductory paragraph, management's responsibility paragraph, and the first 2 auditors' responsibility paragraphs in the standard unqualified audit report. And then we just changed this very last little paragraph to say we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our qualified audit opinion. So again, in the clean report, it's going to leave out the term qualified. That's all. Now, as I said, readers need to know what's wrong. And before they get down to that opinion paragraph, it's not clean. They need to have read through this basis for qualified opinion paragraph. It's added in there. It's often called the explanatory paragraph because it explains just what's wrong. So we have here the lawful corporation's investment in XYZ company, a foreign affiliate acquired during the year. So they bought it during the year. and accounted for under the equity method. By the way, that's something you'll learn about in advanced accounting if you go on to take that in the graduate program. Well, it's carried at $2,475,000 on the balance sheet as of December 31st, and Laughlin's share of XYZ companies, net income of $365,000, is included in Laughlin Corporation's excuse me, net income for the year that ended. We were unable to obtain sufficient appropriate evidence about the carrying amount of Laughlin Corporation's investment in XYZ Company as of December 31st, and Laughlin's share of XYZ Company's net income for the year that ended, because we were denied access to the financial statements, management, and the auditors of XYZ Company. Shame. Consequently, we were unable to determine whether any adjustments to these amounts were necessary. So I don't know why we've been denied access, but we were for some reason. Sounds like there's something to hide there, doesn't it? Oh, well, this client, since they couldn't fix this situation or wouldn't do so, this auditor decided to give them qualified opinion. And by the way, in the end, the type of report that's issued is always up to the auditor's judgment. And oftentimes on the CPA exam, that will be the correct answer to any one of a number of questions, because in the end, everything in the audit really is the auditor's judgment. And I guarantee that a whole lot of people will mess that up on the CPA exam. They won't pick it because it sounds too obvious to be true. But you know, sometimes what's most obvious like that is actually one of the most missed multiple choice answers. It truly is. So this qualified opinion, in our opinion, except for the effects of the matter described in the basis for qualified opinion paragraph, the financial statements referred to above present fairly in all material respects. The rest the same as in the standard unqualified audit report. So except for this one thing that's wrong, we think everything else is okay. That's the qualification, or in this case, qualification having a negative connotation. We don't want it because we don't give our unqualified scores to these financial statements. Again, sometimes students think qualified opinion, that must be a good thing. Well, no, it's not. So the term qualified or qualification, it can be an antonym to each other. Depending upon the sense in which we use it, can be an antonym unto itself, I should say. Almost sounds like cognitive dissonance sometimes. And try explaining that when you're up in front of like 300 people that don't speak English as their native language. It's not fun. I sure did learn a lot about English when I taught in China. Questions there on that. Now, here with figure 3H, you might want to make a little note that this is for the in-between level materiality. So, as I talk here about this in-between level materiality, and I apologize, margin lined up there very well, but this here, again, would be figure 3. Now, let's talk about the worst case scenario where this auditor decided that this scope limitation is highly or pervasively material. Again, that's always up to the auditor. But this auditor will issue a disclaimer of opinion. And you can bet we're going to be seeing that in figure 3.9. So let me come back to the book. Share my screen here. So what we have here, we have disclaimer of opinion due to scope restriction or scope limitation, AICPA auditing standards, again, a privately held client. So in this independent auditor's report, well, we do change wording right at the very start of the report. We don't say we audited. We say we engaged to audit because we cannot conduct an effective audit, basically. That's what that means. The scope limitations at that. The remainder is the same as in the standard unqualified audit report, the introductory paragraph is. Then we'll have the same management's responsibility paragraph as in the standard unqualified audit report. Bless you. Sorry about that. And then this auditor's responsibility paragraph is going to be changed. Let's just see how that is changed here. Well, this says our responsibility is to express an opinion on these financial statements based on conducting the audit in accordance with auditing standards generally accepted in the United States of America. Ooh, because of the manner described in the basis for disclaimer of opinion paragraph, however, we were not able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. Right away, how bad is it sounding? Really bad. So then next thing is that add paragraph to explain what's wrong. So the basis for disclaimer of opinion paragraph, again, sometimes called the explanatory paragraph that's added in. Same wording that we just had, same thing is wrong. Here's what happened. One of two things. Probably in this case, the auditor decided that if this client is not going to allow me to get access to these things I need, I think they're hiding something. I think that this is so bad that I need to rule it highly or pervasively material. And quite frankly, that's going to save risk exposure for me. Could well be. The other thing it could be is that if we change things up just a bit, it could be a bigger amount of dollars that we think is involved in the scope limitation and or a smaller client. That way it'd be a bigger chunk of the client. So something is worse. So now this last paragraph, disclaimer of opinion, bad. Because of the significance of the error described in the basis for disclaimer of opinion paragraph, we have not been able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. Oh, that sure does sound bad. There doesn't. And it is. So, very bad. And in this case, well, how do you think the SEC would view this if this were a publicly traded client? I think the SEC would be very happy. No, they would not. In fact, they're going to say, we don't accept this. We do not accept these financial statements. And client, you're going to have to get your act together. Clean things up. Get another audit done. And get something better than a disclaimer opinion. At least get a qualified opinion. They'll accept that. They won't be too pleased. They'll probably review that client more thoroughly than if they'd gotten a standard unqualified audit report, but still. With this disclaimer of opinion, client doesn't even need to bother filing with the SEC. It's a foregone conclusion. The SEC will give them maybe a couple of months in which to get a new audit and get a better audit. Well, I don't think any client wants to get to that. So it would be a very, very rare occasion we had a client who would not finally allow the auditor access. If we saw that, that would be a very dumb client and a very stubborn. Don't invest in. Actually, what happens if a client is getting to this stage where they've got such problems that they get this disclaimer? And you can bet there are other things going on too. They probably are not very good financial health. That's usually what happens. They've got trouble anyway. And by the time they get to this, they know the handwriting's on the wall. They're probably going to switch to some other type of engagement like a review. By the way, if they are publicly traded, they're probably going to take themselves dark, which means that they're going to no longer trade securities publicly. That happens a lot too. So if you ever heard of a client taking themselves dark or taking themselves private, that's exactly what's going on. And a lot of companies do that as they spiral down. A lot in retailing certainly have. So that could be what's going on. Or maybe we have a client who's going to go into either Chapter 11 bankruptcy, which means they're going to reorganize and hopefully pull out of this, or Chapter 13 bankruptcy, which means they will do what? Liquidate, but go out of business. Yeah. So bad things are in store for this client. We'll keep our fingers crossed for them. Same things happen, of course, to a lot of brick and mortar retailers. I think Bed Bath & Beyond is still public. Pretty sure they've had a lot of financial problems. I bring them up because what happened about 2 weeks ago? Anybody know? CFO committed suicide. Yep, jumped out of a window. So, or CFO or CEO? I think the CEO, or was the CFO? May have been. Yeah, exactly. Whoops, sorry. Huh, it's like that turned the lights off. But yeah, Bed Bath & Beyond, they've got trouble. So now it's time to buy from Bed Bath & Beyond. Gosh, I've been in their store here in South Lakeland for, I don't know when. It's been a long time, actually been a few years. Now, I guess just nothing there I wanted anymore. And expensive. So yeah, they have an online presence, and that takes away a lot of the in-store business too. It's kind of like, why bother going there when I can order it online from the comfort of my home and have it shipped to me free? Okay, any questions there so far about scope limitations? Okay. Well, next I'd like to go through the same thing, and let me turn up these lights a bit for departures. Now we've got some sort of statement of financial statements. So as I have my little eraser here that you can tell is pretty chewed up. By the way, with the indentation here, looks like they probably use that to prop the door open. Have you seen erasers in the doors here? Yeah, because they have locks that people can't open sometimes. And just like that, study room right across the way. So I think that's what's happened to this one. Oh, well. Let me go ahead and think about this. I'm going to switch from scope limitations to departures from GAAP. So misstatements in the financial statements, in other words. Or if this client has another basic accounting like cash basis, just ran into that, departures from the cash basis or the income tax basis, or IFRS, whatever it may be. So they're not following the financial reporting framework they should for some reason. So a departure from GAAP, we know that could be something like a posting error, a mathematical error, an error in interpreting financial accounting standards. The client tried to follow GAAP, but they didn't. It's just like a student in financial accounting doing something wrong on an exam or a homework question. They applied GAAP wrong because they didn't understand. Could be an error in self formulas or some other software error. So something isn't quite right. Now, at least this time, we're going to know how many dollars are involved. It's not like a scope limitation where maybe we don't know how many dollars are involved. Departure from GAAP, we do. So things are more certain, shall we say. So when it comes to this departure from GAAP, most departures we find are immaterial. Well, you know, a little mathematical, a little posting error, etc. Nobody really cares. They happen all the time. Also, quite frankly, there is no intent. Nobody was intending to do something wrong. So quite frankly, that's another thing that points out that, well, this truly is immaterial. Nobody cares. So as always, with something immaterial, it could be a situation where, well, let's just go ahead and issue the clean opinion, standard unqualified audit report. Now we'll see how later in the course we still keep track of immaterial errors we find. If they're individually material, the grand total might be material later. That's for another day. Now, let's say this departure from GAAP becomes bigger. More dollars, we're in the in-between materiality level phase. Bigger chunk of the client. Then we need to change this audit report. Again, at the auditor's judgment. So it will be, again, modified or qualified. It will say something's wrong. But let's say it's really bad. Then we enter the highly or pervasively material phase. So if it gets bigger, 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 or if it seems that the client intended to make this departure. Now, why would a client intend to make a departure from GAAP? Why are they doing?
Sure. I'd say convenience is probably a reason.
Well, it could be a lazy client. You know, they'll pay big consequences for their laziness. So penny wise and pound foolish. Yeah. But some people are like, duh. Especially if they don't realize the implications of accounting. Another thing that could be going on for this deliberate departure from GAAP could be what? Fraud. So it could be that this client is trying to deliberately misstate their financial statements. Again, probably overstating assets, revenues, and or gains, understating liabilities, expenses, and or losses. Trying to make things look better. And maybe they're trying to deliberately misstate disclosure, like leaving off a troublesome footnote. Think about a lawsuit. So if this is intentional, That's another reason why it's going to zoom up to the top in terms of materiality. Client is trying to manipulate the financials. Very bad. But the auditor says, I'm going to play it really safe. I'm going to give this client the worst case scenario type of audit report. They're going to give them what's called an adverse opinion. Adverse opinion is going to say that we believe these financial statements are not in accordance with GAAP. It's going to be really, really bad. How many clients do you think want that? They don't. These are extremely rare, extremely. In fact, even audit reports which are qualified because of departure from GAAP are pretty rare too. Now, why do you think that most clients are not going to let a material misstatement, material departure from GAAP, same thing, go out the door? Well, there are bad consequences, yes. And for a departure from GAAP, a client can fix it. Maybe once in a blue moon, but that would be rare. So I should say virtually every single time. I don't want to make 100% guarantee. You know, we must never give absolute assurance in auditing, but almost all the time, the client is going to fix what's wrong. So that's why I've said before, the audits often tend to be a big cleanup act in the end. So with these departures from GAAP, let's see a few things here. First, if we go to the notes, and second, if we go to the book. So here in the notes is we look at D. So a departure from GAAP will cause the auditor to issue either an adverse opinion if it's highly or pervasively material, or a qualified report if it's somewhere in between in terms of materiality. We'll see examples on page 65 in a second. Let me look the first three notes here, though, before we do. First of all, in the qualified report, only the opinion section is qualified. And that's because effective audit was conducted. Again, the term except is used. On the auditor's responsibility section, it's not qualified or changed in any way, again, because effective audit occurred. Now, neither is the introductory paragraph nor the management's responsibility section modified. So all the same things still apply there. And then second, in the adverse opinion, the opinion section is going to state that the auditor believes the financial statements are not clearly stated in accordance with GAAP. And then number three in both reports, a section for the basis of the qualified or adverse opinion is added, and it precedes the opinion section, again, because it changes the opinion section. So the reader has to read through this explanatory paragraph, and has to see what's wrong before they get to the opinion. Again, that placement is quite important. It's tested on the CPA exam. And I apologize if you're watching this. I forgot to go ahead and add to show you where I got that from, because I forgot to share my screen here. So where did I get that? It was here in D. Yeah, I looked at 1, 2, and 3. So if you'll please look at that there in your notes. And let's go ahead and come back to the book. So let's see this in action here in the book. So as I go here to page 65. Going to look at figure 310 first, qualified opinion report due to non-GAAP, departure from GAAP, under AICP auditing standards, again, for this privately held client. So figure 310, you'll want to make a little note that figure 310 here is for the in-between level of materiality. So I'm going to make a little note here. This is 310. Safe bet. This adverse opinion will be 311. Cost a minute. So coming back here to the book. $310. So here's the independent auditor's report. First of all, we see the same introductory, management's responsibility, and auditor's responsibility paragraphs as in the standard unqualified audit report. But only the last sentence of the auditor's responsibility paragraph will be modified as shown next. So it says, we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our qualified audit opinion. So we just add that one term in there, qualified. Otherwise, everything we did the same as if we had a client getting a clean opinion. So now we add in this basis for qualified opinion paragraph, again coming before the opinion paragraph itself, because the reader needs to know what's wrong. So the reader reads through this explanatory paragraph, the basis for qualified opinion, in other words, and they see, ooh, here's what's wrong, and this is why the opinion paragraph is not qualified. So this basis for the qualified opinion, let's see what's in there. The company is excluded from property and debt in the accompanying balance sheet. Certain lease obligations that, in our opinion, should be capitalized to conform with accounting principles generally accepted in the United States of America. So talking about leases here, does everybody like leases from financial accounting? Ooh. Okay. Well, this poor company was probably so confused that they just said, oh, to heck with it, and threw in the towel. Can't say I blame them. I'm glad I don't teach upper division financial accounting. Tell that to a certain someone. No, she knows I'm glad. I leave it to her. So they did something wrong here. Now, we see if these lease obligations were capitalized, property would be increased by 4.6 million, long-term debt by 4.2 million, and retained earnings by 400,000 as of December 31st. A net income and EPS would be increased by 400,000, $1.75 respectively for the year then ended. So, I'm not quite sure why this client steadfastly refused to do this, because everything was favorable, all the effects of correcting this problem, except for the increase in long-term debt. But even then, net assets went up by more, or rather assets went up by more, and therefore net assets went up by more as well. So it sounds like this auditor was quite certain about these amounts, and it looks like the client could have paid the auditor a little bit more to get expert advice as to how to correct this. Maybe they were just too cheap. I don't know. Again, that can be a sign of impending financial trouble. Can't afford to pay the auditor, perhaps. But whatever is going on, it's not good. So this client steadfastly refused to correct this. May I add that this is a very dumb, stubborn client. It really is. But anyway, this client is digging their heels in. So if we have such a dumb and stubborn client, well, we're going to say, okay, this client will correct this problem like way, way, way over 99% of other clients would. So we're going to give them a qualified opinion here. So in our opinion, except for the effects of the matter described in the basis for qualified opinion paragraph, financial statements referred to above present fairly and the remainder is same as in the standard unqualified audit report. So that's the qualified audit opinion for this problem. Would you, as a stockholder or as a creditor, be very pleased with this? No. As a stockholder, you'd see, wow, you know, EPS, each one of my shares, that would have gone up by $1.75. So my stock price would as well. I'm not pleased with this management team. I don't know what's going on, but again, they're dumb and stubborn. And I don't think that new investors would be very tempted to invest in this company unless they thought they were going to get a real bargain. So this is something that would definitely drive down the price per share. Any questions there on that? Right, let's go to figure 311. Now in 311, come back here for a moment. In 311, we're going to go to this worst case scenario, the highly or pervasively material phase. So this problem has really misstated the financial statements. The dollar amounts are so big that they've pervaded the financials. As we can see, this affected assets on the balance sheet, affected long-term liabilities on the balance sheet, affected stockholders' equity on the balance sheet, affected the financials, affected the income statement too. And it just pervades things. With so many dollars, with such a big chunk of these financial statements, in other words, that we think these financial statements are just totally messed up. So it's time for this worst case scenario audit report, the adverse opinion. Again, it's a bad one. So let's take a look at it here in figure 311. Okay, figure 311. Sorry, the resolution here on the screen sometimes doesn't come about so great. Also because this glass board is getting dirty. They have to be cleaned every now and then because they will retain some of the pigment from markers. So yeah, someplace in my office, I've got a little bottle of the special spray cleaner. I'm going to have to bring that in here one of these days, I think. You know, there's an old saying, if you want something done right, you have to do it yourself. That's right. There's another good one, kind of similar. And it is, if you want a helping hand, look to the end of your arm. Yeah. All right. Let me come back here, sharing my screen as I go back to the book. So figure 311, this adverse opinion. So independent auditors report, there are the lights. Just as soon as I ended what I was talking about on the board, so good, they cooperate. Yeah, again, are we ever going to set up a betting pool as far as how long these lights will stay illuminated? No? Okay. It's a losing bet. So the independent auditors report. Well, same introductory, management's responsibility and auditor's responsibility paragraphs as in the standard unqualified audit report. Only the last sentence of the auditor's responsibility paragraph will be modified as shown below. It's a real easy modification. We believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our adverse audit opinion. So the basis for the adverse opinion. Again, same wording as in the basis for the qualified opinion that we just had with the previous figure. So same thing is wrong. Again, this could be a smaller company, so this is a bigger chunk of the company, or very, very likely it's another auditor, and this auditor is more conservative. This auditor said, well, if this client is not willing to correct what's wrong here, I'm going to play it safe and give them an adverse opinion, at least safe for me. So let's see the adverse opinion paragraph. It's bad. In our opinion, because of the significance of the matter described, the basis for adverse opinion paragraph, the financial statements referred to above do not present fairly the financial position of Ajax Company as of December 31st, or the results of its operations and its cash flows for the year then ended. That's bad. Really, really bad. Now, whoa, what's going on? Makes me nervous, especially with lightning in the distance. Okay, let me turn up the lights a bit and see if that solves our flash problem here. Okay, good. Okay, the mildest of technical issues. Be grateful. So, with this adverse opinion, it's bad. Now, I realize this is a private company, but if it were an SEC company, what do you think the SEC would say? Do it again. Exactly. You've got a certain amount of time to fix this problem. By the way, while you're at, look for any other problems, because something else surfaces, they're going to be in trouble again. So fix it, get a new audit, get something better than adverse opinion. Otherwise, the SEC is going to say, we're going to take you dark. We're going to delist you. That will happen. Now, by the time a client gets one of these, what kind of shape do you think they're in anyway? No shape at all. It's a good way to put it, Shelby. No shape at all. Now, I've seen very few of these in practice, and I think for every single one, the client went bankrupt afterward. That is definitely the usual scenario, because by the time they get here, they've got bigger problems than the audit report. The audit report is just another nail in the coffin. And by the way, when a client does go bankrupt, what triggers it? It's because they ran out of cash. They can't pay creditors. So creditors force them into bankruptcy and bankruptcy court. So that could well happen in this company here. And that foreign affiliate may resent having been bought by XYZ company. Yeah, like I said, I've seen very few of these in practice. I think every single one went bankrupt. One that I did see was coming in Tampa several years ago. And the company in Tampa was in a very, very, very declining industry that I think is almost kaput now. And they were a payphone provider. How much demand is there for payphones? Very, very little. That's exactly right. So there actually is a market for payphones, but that'll be in the course of neighborhoods, to tell you the truth. So there we would have a person who's indigent having to get changed to make a call. I guess payphone calls are still 50 cents. I don't know. I haven't used one in over a decade. Has anyone ever used a payphone? No. Ooh, and I always hated to touch them. German. But yeah, there is still a market for payphones. A little bitty. I know a good place for us to look for a payphone. Scott. I bet you there's one out there. And if we went to some neighborhood turn-away point, we probably find one someplace like a convenience store. Here's why I say that. Yes, there are people that can't afford a cell phone, even if they don't receive a free cell phone from the federal government. So let's say somebody's so unfortunate they don't. Well, the guy gets change, uses payphone. Okay. The other type of party that may be very interested in using the payphone is somebody up to illicit activities. Right. So, like one's local drug dealer. So, well, they still use payphones, but sometimes. But yeah, the payphone industry is tiny. So this company was just caught in a very declining industry, and they went bankrupt as a result. But by the time they finally got that adverse opinion, and it was way, way, way after their fiscal year end, they were down the tubes in. Another place where you can probably find a payphone, an airport, a mall, that's right, bus terminal, like the bus terminal downtown or Greyhound bus terminal, maybe a train station, places like that. I don't think there's one on campus. Could be wrong. But yeah, trust me, you don't want to pick up a German payphone. Ooh, and put your ear where everybody else been doing the same thing and hope there are no headlights on the receiver. Gross. But no, they weren't pleasant. Having to carry change wasn't very pleasant. But to someone who's indigent, having to pay for calls, even if they aren't just 50 cents, would really add up. It's expensive to be poor. Yeah, and it's estimated that over 10% of an indigent person's pay is spent on financial services. I guess we consider this financial service. But they're having to do all kinds of things, including they can't pay bills in full, so they're incurring interest. They don't have much in the bank, so the bank's nickel and diming them for every type of service. Whereas a large balance customer, they give them everything for free almost. Yeah, because that small balance customer costs the bank a lot of money to maintain. So the bank will make them profit. That's why they're going to ask that. This would be poor. So you can see why once someone gets into that, it's really difficult to get out. For people. Okay. Questions there on the adverse or the qualifier. All right, let's come back here to the notes. I'll share my screen again. And here in the notes, I'd like for us to take a look. Just a few other things under here. Well, here in number 4, under D, a qualified report is also issued if there is an inaccurate disclosure, or if not all the required financial statements are present, which is called an incomplete presentation. An adverse opinion is not really applicable in these special departures in GAAP, although it could be used in very, very, very rare circumstances with an inaccurate disclosure. And maybe I should add here, especially if the auditor feels that the financial statements are misleading as a result. The auditor sure doesn't want that. Now, also, if the statement of cash flow is omitted, and that's usually the only one might be because client didn't understand it. Well, the auditor should not mention cash flows in the audit report except to qualify it. Also, the auditor is not going to have to prepare the statement of cash flows. So something like an adequate disclosure. Well, the auditor says to the client, you don't have a footnote in there that you need. What will the client do almost all the time? Add that footnote, yes. They may not be very fond of disclosing what is wrong, especially if it's something embarrassing like an embezzlement. Somebody stole from them, they sure don't like to admit that, but it's better than suffering the consequences of where they get a qualified audit report. So with that, client will go back and add the footnote, maybe grudging. They fix whatever's wrong again. But if the client will not add that footnote, and then they get a qualified audit report that says this footnote should have been added, and then the auditor discloses all the information that would have been in the footnote, how dumb is that? Really, really dumb, really stubborn. Just like the old saying, cutting one's nose off to spite one's face. So don't invest in that company. Let me see, I can't remember if there's one of these here in the book. Let me just double check. There used to be, but I don't think it's still in there. There used to be one with an adequate disclosure, but it looked just like the audit report that we have here in figure 310. Same type of deal, except it just has a really embarrassing explanatory paragraph saying what should have been the footnote and that the client should have added. Dumb and stubborn client. I'm sure the auditor had to bite their tongue. All righty, back here on note 5. Now let's say this. This kind of leaves a little out for a client that has special circumstances. Well, if the auditor agrees with a departure from GAAP due to special circumstances, he or she may issue a clean opinion under Rule 203 of the ACC's Code of Professional Conduct. That's what's in Chapter 4. That is the background chapter, one of two background chapters. So if there's clearly some exception, and after all in life, as we talk about rules, they are for general situations, but sometimes there are special circumstances, special situations where we have to depart from the rules. And generally in life, that's going to be okay as long as we justify what we're doing. Same thing in audit. So this client has special circumstance. So we can do it, but we must add a basis of accounting section after the opinion section. The opinion section will be unqualified, but will reference the basis of accounting used. And there's an example in Exhibit 25.8. We'll cover that later in the course. You can take a look at it if you're really interested. That's going to look just like what I described. So let's say that we have a client with special situation. Most common is a basis of accounting other than GAAP. So if we have a client who's on the cash basis or income tax basis or IFRS, or we have an insurance company and they must report a set of GAAP financial statements and a set of financial statements, the second set, which is under statutory accounting principles. That's departure from GAAP, but again, very justifiable. So as in life, sometimes we have to do things out of the ordinary, but that's okay as long as we can justify it. Not a problem. Now that basis for or rather, I'm sorry, that additional paragraph which comes in there, the explanatory paragraph, goes after the opinion paragraph. And the reason it does is because it doesn't make the opinion not clear. It's okay. So the reader doesn't need to know that before they read the opinion paragraph. Now, number 6. Let's just remember once again that the auditor gives client a chance to correct any departures from GAAP before issuing a qualified or adverse opinion. Now, a little bit of background. First of all, generally the client gives the auditor the adjusted trial balance. So the client has gone through everything at year end, normal stuff, and it's made year-end adjustments. Here's the adjusted trial balance. Well, those adjusted trial balance amounts, the client will assert are fairly stated. Now we know that we're an auditor. We're professionally skeptical. We don't fully believe that until we see evidence to back it up. So there's where we'll gather evidence. But the client says or asserts that these amounts, these dollar amounts that will eventually go on the financial statements or on the adjusted trial balance are fairly stated in accordance with GAAP in all material respects. Then the auditor checks those out. So the account balance on this trial balance, the auditor tends to call book values. That means here are the amounts on the client's books, unaudited at this point. Well, the auditor will then gather evidence to determine the appropriate balance for each account, which is the audited value. And if there's a difference between the book and audited values, the auditor will propose an audit adjustment to the book value. So let's say that the client asserts the customer's account receivable has a balance of $5,000. Well, that's on the client's adjusted trial balance, as the client calls it, but the auditor calls that the client's book values. They are unaudited. So the book value of that account receivable is $5,000. That's what the auditor would say. And the auditor would say, I don't fully believe what the client's asserting there until I gather evidence to back it up. So in this case, I would confirm that account receivable. Well, if my confirmation, I get back from this client's customer, says 5,000, that's great. I'm done. If it's something different, if it's off by a material amount, we're going to have an adjustment. So let's say that this confirmation comes back and confirmation says the balance is only $4,500 because I, the client, made a payment on that account receivable. It has not been recorded. And it's been long enough that the check's not in the mail anymore. So the client has a discrepancy there. Would you say the $500 out of 5,000 is material? Yeah, we'll get to rules for materiality later, but 10%, yeah, it is. Trust me, rule of thumb. So in this case, the auditor will say this account receivable needs to be written down by $500. Fix a client. It's material. It's up to the client to decide whether to actually record this reduction, though. So that reduction of $500 is the audited, excuse me, audit adjustment that the client proposed, or rather that the auditor proposes that the client make. It's up to the client. Well, then B, clients may or may not choose to record the audit adjustments. It's up to them, it's their books. Now, if they do not record material adjustments, then the financial statements will not be fairly presented in accordance with GAAP, and the auditor will not be able to give a clean opinion. So again, any sensible client is going to do what? Fix it. Yep, they'll record that adjustment. Otherwise, if so stubborn, so dumb that they don't, they'll suffer some big consequences. And are there people in life that just seem to willingly suffer such consequences? Oh yeah, they don't have their lessons. We all know them. Businesses can be the same because after all, they're run by people. Hopefully not a publicly traded client, but a small client can be. They won't stay in business too much longer. Okay. Any questions there? We have another situation that's wrong. It's here anyway. Well, if the auditor is not independent, then there's a special type disclaimer of opinion which must be issued. We'll see it on page 66 in a second. You should not see this in practice, as the auditor would not have accepted the client, or would withdraw as soon as the auditor saw they were independent. Remember that materiality is not an issue with independence. Either you're independent or you're not. It's just binary. It's a binary value. Either yes or no. There's no in between. So just like you own one share of stock in a client out, millions of shares outstanding, we could say it's an immaterial amount, but for auditing purposes, it is a material amount because the appearance is such that the general public's going to think that you're not independent. Sure don't want that. Well, let's see this type of audit report that we need to issue here. So I'm going to page 66. It's really short and simple. Here it is in figure 312. Disclaimer due to lack of independence. So short, sweet, and simple. First, notice there's no report title here. We don't even entitle it. We don't address it to anyone. All those various bells and whistles are not there. Here's the only thing it says. It says we are not independent with respect to homedaycourse.com on the accounting balance sheet as of December 31st and the related statements of income retained during some cash flows for the year that ended were not audited by us. Accordingly, we do not express an opinion. So we disclaim an opinion because we were not independent. Well, you know, that is casting aspersions upon the character of the auditor here, to tell you the truth. Because if this auditor had exercised due professional care, they shouldn't have accepted this client's start. They've got some poor quality control going on. And if they did discover someplace to know that they were not independent, what should they have done at that point, do you think? Should have withdrawn. So should have withdrawn. And oops, let's like that. So I sure hope that we don't see one of these in practice, because if we do, ooh, that's not good from the auditor standpoint. The one place where I can remember that some of these were issued was back, it's like 1997, 98, when the former firms of Pricewaterhouse and Coopers & Lybrand merged to form PricewaterhouseCoopers, now in this desire for CPA firms to call themselves by initials, PwC. Well, some of the former Coopers, Pricewaterhouse was really the surviving firm. So some of the former Coopers & Lybrand people did not sell their stock as they were supposed to, because suddenly some new clients came into this combined firm, and again, these former Coopers people owned some stock. The main person who owned some stock, by the way, was a trust fund baby who worked in the Tampa office. He was a former Coopers person. He didn't sell his stock as he was supposed to. the stock was in clients in this combined firm, and the SEC finally got hold of it. Well, the SEC, they weren't as mean to the firm as I thought they would be. They fined the firms like 2.5 million at that time, and the firm had set up an education fund to help educate their people on independence. So this auditor and others who own stock, they were all ordered to sell the stock so they would then be independent. Well, a few months later, the SEC reviewed and they found that they hadn't sold, not all of them had sold, especially this trust fund baby that obviously felt very entitled. So what happened then was that the SEC increased the fine. And again, they weren't as mean as I thought they would be. But it's interesting, that happened over in the Tampa office. And obviously that was a very bad quality control issue that they encountered in this new combined firm. So they paid, but that's the only time I've ever seen this. So I don't think we're going to see it. But again, we know what would happen if, heaven forbid, the CPA firm got in there and found they were not independent. They shouldn't have been there to start with. All right, well, that's where we get to today. And we have a little bit more of chapter 3 to finish up. We'll be finishing up when we come back on Wednesday. Okay, no questions or anything? Okay, very good. For those of you watching remotely, let me know if you have any questions. And everybody take care. See you back on Wednesday. Bye-bye.